Hello, welcome to Financial Markets Weekly, an audio podcast by Succinct Information. This is a professional summary, free of noise, focused on facts, and straight to the point. We help you save time while covering the key events and market performance. These are the highlights from last week.
The uncertainty in the Middle East and the risks of a military escalation continue to determine the performance of markets. A mixed bag of corporate earnings reports in the US, and a sharp rise in bond yields triggered a sell-off in risk assets, and equities fell sharply across regions. Let's cover equity markets first. The S&P 500 fell 2.5% on the week, while NASDAQ indexes did even worse, as well as European benchmarks, with declines of more than 3%. Emerging markets also traded lower, with Chinese stocks plunging more than 4%, to their lowest level since March 2020, after Country Garden, formerly China's largest developer, failed to repay its offshore debt. There were a couple of US mega-cap names that ended significantly lower. Tesla reported sales below those of a quarter and a year ago, and Elon Musk offered a pessimistic outlook for the economy. Although demand for cars remains strong, producing them at a competitive price is proving a challenge. Tesla shares ended 15% lower on the week, its worst week in 1 year at $212, for a market cap of $673 billion. Nvidia, the giant chip manufacturer, fell 9% after Biden's administration announced plans to halt shipments to China of the most advanced semiconductors made in the US, to prevent Beijing from gaining access to American technology that supports the development of artificial intelligence computers. China accounts for 20% of Nvidia's global revenues. The Philadelphia Semiconductors Index fell 4% last week. Investment banks Goldman Sachs and Morgan Stanley reported mixed results, with robust trading figures both in equities and fixed income, but weak investment banking and wealth management results. The drought in corporate deals and a high interest rate environment that reduced the need for individual customers to trade hit revenues. Onto currencies and bond markets. The dollar index fell mostly against the Swiss franc and the euro as investors seek safer currencies. The yen briefly traded above the 150 level, triggering rumors of another intervention by the Bank of Japan. On a year-to-date basis, the dollar index is now up by 2.5%, with the Japanese yen as the weakest pair, followed by the Kiwi and the Aussie dollars. Bonds resumed their downward trend, with yields climbing sharply. 10-year Treasury yields added 30 basis points to 4.92%, marking a 16-year high, and remaining the highest yield for the tenor among developed nations. Bund yields added 15 basis points to 2.88%, while British gilt yields advanced 27 basis to 4.66%. On the economic front, there was only one monetary policy meeting in developed countries by the Bank of Korea, which left rates unchanged at 3.5%, and limited data updates. However, Powell's remarks before the Economic Club of New York provided markets with more information to anticipate the Fed's next move. Although he maintained the door open for more hikes should the economy strengthen, his comments were less hawkish than recent ones. Traders are pricing in a pause in November 1st, and a 68% chance of another pause in December. In commodity markets, crude oil continues to shift higher on risk of production disruptions, should tension in the Middle East escalate. Brent added 1.4% to $92. The highlight in commodities was the steep fall in US natural gas prices, with a 10% drop to $2.90, mostly on record supply, sufficient storage, and stable demand. Next week, the ECB meets on Thursday and markets are pricing in a 98% chance of no rate change from the actual deposit rate of 4%. The Bank of Canada meets on Wednesday. On Friday, we get the latest US PCE inflation update. It will be a busy week for earnings reports, including Microsoft, Alphabet, Meta, Amazon, Exxon, GE, Ford and Coca-Cola. That's all for this week. Please subscribe to the channel and help us promote it. Visit succinct.info to learn more about our subscription.